You have $100. You put it in the bank. The bank lends 90 of those dollars to someone else. That person deposits it into another bank, and that bank lends 81 of those same dollars to somebody else. At this point, almost $300 are already circulating. From your original $100 bill, nobody printed anything. Nobody counterfeited anything. It's completely legal. This is called fractional reserve banking, and it's the secret that holds up the entire global financial system. And the most unsettling part is that we've been living with this system for more than 3 centuries without most people knowing exactly how it works. Let's build it from scratch, step by step, because once you understand this, you can never look at money the same way again. Imagine you own a small bank. I walk in and deposit $100. To you, that deposit is a debt. You owe me, the customer, those $100. But the law gives you a huge privilege. You don't have to keep the full $100 in the vault. You only need to hold back a fraction, a percentage set by your country's central bank. Let's say that percentage is 10%. That's $10 you actually keep locked away. The other 90 you can lend out to whoever you choose. Someone named Carlos walks in asking for a loan to start his business. You lend him those $90. But here's the key detail almost nobody explains properly. Carlos doesn't walk out with that cash under his arm. What normally happens is he deposits it into his own bank to pay his suppliers, buy inventory, or just have it available. That second bank now has $90 deposited by Carlos. And guess what? That bank also only needs to hold 10% in reserve. That's $9. The other 81, it can lend out to someone else for another business, another house, another project. And the chain keeps going. Over and over, each bank holds back a small fraction and lends out the rest. That loaned money becomes a new deposit in another bank, which in turn lends out most of it again. By the end of this chain, which can have dozens of links, your original $100 can turn into nearly $1,000 in deposits circulating through the entire economy. Economists call this the money multiplier, and in theory, with a 10% reserve requirement, that multiplier can reach up to 10 times the original deposit. That new money didn't come from a printing press. No new physical bills were created. It came from a number on a screen, backed by the promise that Carlos and everyone else down the chain will pay back their loans with interest. This is, quite literally, how most of the money in the world today is created. Not the bills and coins in your wallet, the numbers, the digital figures living inside bank computers. In fact, here's a fact that surprises almost everyone. Physical cash and coins make up less than 10% of all the money in circulation in most modern economies. The other 90% or more is this: promises, loans, numbers in accounts moving from one bank to another without a single physical coin ever changing hands. And here's the part almost nobody knows, not even people who use the banking system every single day. Central banks, like the Federal Reserve in the United States, the European Central Bank, or your own country's central bank, don't print money and hand it directly to people on the street. What they do is pull certain levers that affect the entire system. One of those levers is exactly that reserve percentage banks are required to hold. If the central bank lowers that percentage, commercial banks can lend out an even bigger portion of every deposit, which means more money circulating without a single new bill being printed. Another lever is the interest rate at which the central bank lends money to commercial banks. If that rate drops, borrowing becomes cheaper, more people and more businesses take out loans, and once again, without printing anything, more money starts moving through the economy. If the rate rises, the opposite happens. Borrowing gets more expensive, people take out fewer loans, and the pace at which new money gets created slows down. It's exactly like opening or closing a water faucet. The central bank doesn't create the water coming out of that faucet, it just decides how fast it flows. And that flow, faster or slower, is what we all feel as inflation when there's too much money circulating, or as a cooling economy when that flow gets shut too tight. Now, this system isn't perfect, and it has a weak point. History has proven more than once. If enough people decide at the same time to go to their bank and pull out their cash, the bank won't have that money available because it already lent most of it out following the exact chain we just walked through. This is called a bank run, and it's one of the reasons deposit insurance exists, guaranteeing deposits up to a certain amount so people can trust their money is safe, even if the bank doesn't physically have it sitting